Hello, this is Mike Swanson of WallStreetWindow.com. Thank you for joining me. This is 10 a.m. On November the 20th. It's Tuesday. Of course, Thursday will be Thanksgiving. Historically, this is a week in which the stock market almost always goes up. This is the week in which the odds of it going up are more than any other single week of the year. And as you know, people speak of seasonal trends such as midterm election rallies, end of the year rallies. But when seasonal trends that's supposed to work do not work, that is a serious warning sign. Now, I'm going to get to the live charts in a minute. Typically, it takes a few minutes before people join the live session. They don't seem to appear in time. But I've created a PowerPoint presentation today, and we're going to talk about, try to understand what's going on in these markets and where the best places to actually make money are, and that's going long too. But first, I want to tell you this is real, okay? Back around right before Labor Day, I opened up a new account with Robinhood, a small account. I have a large account, of course, but I decided to open up a small account with is like an educational thing to focus on 7 positions at one time. So dividing the account into 1/7, and it's up. This is actually a screenshot from yesterday because if I were to log into Robinhood, it would show you the positions, and I can't do that because this video is going out on YouTube to the entire world, and the actual information on the positions is reserved for my private Power Investor members. That said, I'm going to run a special right now for you to take a trial so you can get the positions and see all the changes I make. I send out notifications when I do for only $7.97. That offer is going to end on Cyber Monday. But anyway, this is the close of the account as of yesterday, and it's actually going to be up a little bit more today. But I'm not trying to hype you up by showing you this at all, because as of the close yesterday, it's only up 0.83%. And a year ago, I'm sure you saw promotions for Bitcoin saying if you use it's the way to get rich, put in $100 and make $1 million. I saw promotions actually saying that. I even saw promotions saying that about the stock market too, with individual charts, which was kind of ridiculous. But anyway, most people are down since I opened up this account. And what I'm trying to do with the account is not get rich overnight, but to not have an account that's having massive swings every single day, up or down, which is what can start to happen to people if they're fully invested in the market or even a margin in this environment. But one with steady growth. I can't get rich overnight because I'm not willing to take the kind of risk. Because if you're going to risk $100 to make $1 million, it's like going to the horse track and betting on a long short horse. And that's why most people who try to do that in Bitcoin lost money. Bitcoin was not real last year. This is a chart, and this chart's from last night. I'll get to live charts after this PowerPoint presentation, but I put this together last night thinking about things. And again, last year it went to 20,000, and this morning it's at 4,500, so it's down another 10% from the close yesterday. Total friggin' disaster. But what's important about Bitcoin is in the financial, 2 things. First, as I've been hinting at, in the financial world, people make wild claims and wild promises to get rich overnight. And this is not a time for that at all. This is a time to reduce risk. It's a time to go to real investing fundamentals. And investing fundamentals does not mean believe in a stock like Apple and hold forever. It means understanding how the trends of the market work and adapting when they change. And so many people a year ago bought into the hype of Bitcoin with promises it was going to replace the US dollar or go up if the stock market fell. All those promises proved to be complete hoaxes. Instead, though, what Bitcoin really was and represents was a speculative arena of the stock market, the global markets, not just in the United States, but all over the world. People were opening up Bitcoin accounts, trading it, not, in its complete speculation. And to me, it was similar to what internet stocks did in 1999 because they were the speculative arena back then. And the masses were chasing them and getting into them, not caring if the companies were real or not. And the result was disaster. But internet stocks, the final speculative pocket of that bull market that really lasted from 88 to 1999 or 1980 to March 2000, if you want to think of it the real long term. But and here, I think Bitcoin was the last speculative phase of a bull market that really started in 2009 all over the world, not just in the United States. But turning back to Robinhood, and again, this is a screenshot. And I'm doing this because I can't log into the account and show you live, but showing you the positions, which are for the private group, the private power investor group. Again, you get the trial 797 and you can get the positions. But this is interesting because this is the most, these are the 100 most popularly owned stocks ranked by the number of people who own them. At the top of the list, Apple, GE, Ford, Facebook, AMD, Microsoft, Kronos Group, which is a marijuana stock. And then after them, Fitbit, GoPro, another marijuana stock, Amazon, Netflix, Snap, Twitter, Canopy Growth, Alibaba. All these stocks, almost every single one of them, it could be all of them, they're below their 200-day moving averages. And they're falling. And this is what everyone owns. And there's one ETF in this list of 100 as of yesterday's close, which is a short selling ETF. And it's an ETF shorting natural gas that also is in sharp decline. So what this tells us is that the masses of investors in the stock market are owning stocks that are declining. And there's no real fear in the market. No one is shorting the market to try to hedge themselves on Robinhood at all. So this is where we're at. And that's a scary situation and is ultimately the reason why the stock market is declining. Now, people are talking about bad news stories. In fact, yesterday I heard Jim Cramer say there's bad news about Facebook. And there's bad news about Apple. And if reporters would just stop reporting bad news, the stocks could stop dropping. He actually said that before the opening bell. Well, when news is bad, stocks can go up too. There's a saying that bull markets go up a wall of worry, a wall of bad news. So news does not really ultimately drive the stock market. It's the overall trend. When you're in a bull market, bad news is buying opportunities. Remember Brexit? The stock market gapped down hard the day after the Brexit vote and just continued higher. Brexit was supposed to be bad news, but it didn't matter. The Trump election was supposed to be bad news, and the market actually fell overnight in the futures market, and then, of course, went up from there. A bad news is a buying opportunity in bull markets, but in bear markets, which I think we're actually tipping into, or already in, and I'm going to explain why, all news is bad. Or all news is a selling opportunity, whether it's good or bad. How many stocks did we see last month report positive earnings and gap up and fade? For instance, Adobe did that. And of course, there were stocks that gapped down on earnings and blew up, even if the earnings were good. But every stock that had good earnings, 90% of them gapped up and just have faded and are lower ever since. The only ones still higher are defensive stocks that gapped up, and like a Procter and Gamble, I think did that, gapped up and continue to go up. All the others are dumping, no matter what the news was, good or bad. And that tells us something about the trend of the market. It's not the news that drives the market action. It's the trend. And when trends are down, people sell the news, good or bad. Now, as another demonstration of what's going on in the stock market, and I say all these things, I do want to say I do think we could actually get an up day tomorrow in the stock market or Friday because the seasonal trends are indeed powerful. But does it really matter if there's one or two up days when the stock market is trading the way it is and almost all the stocks are below the 200-day moving averages? And this is a major point that we're going to revisit in a few minutes. But there's two ways to really be making money in a market like this. And it's to be in the few sectors that are bucking the overall trend, defensive sectors and sectors that in asset classes that actually can benefit from a bear cycle, which is going to result ultimately with the Fed ending the interest rate hikes and cutting rates and causing some wild movements in the U.S. dollar. Gold will go up in that environment. Mining stocks will go up in that market environment. And gold is up since the first day of October. But the other way is to bet against junk stocks. I call them POS stocks. You can guess what that stands for. But these stocks are collapsing. So Monday, last week, on the 12th, I released a report to my Power Investor members with 5 stocks that I actually am betting against by short selling them that are junk, that I thought would drop very hard into the end of the year. These stocks are in collapse. This is what they did Monday, yesterday, alone in one single day. Stock number 1 down 4.95%. Stock number 2 down 5.45%. Stock number 3 down 4.63%. Stock number 4 down 6.62%. Stock number 5 down 3.63%. How much more will these stocks fall before the year is over when they fall this much in one single day? And I could even make this look even more dramatic by showing you what they're down since I released the report, because it's actually unbelievable, especially when you factor in the action today in the first 40 minutes of trading alone. Now, if you buy puts on stocks like these, you can actually get exponential gains from a small investment. With options, I warn you that you can only put in a small percentage of your account in options trading, because if they don't go in your favor, you lose everything. And that's why people do different kinds of trading, but I personally do more short selling. There's better people at options trading than me, and they're worth listening to. But this is this is how you make money in a market declining below its 200-day moving averages. You don't do it by doing what Robinhood traders are doing in a whole, the masses, and hoping Apple is going to go to new highs, hoping every down day is a buy day. When you go against the trend, you lose money until the trend changes. And there's no evidence that this downtrend is over, even if we can get an update tomorrow, hopefully, or Friday, hopefully, even for 3 or 4 days or 3 or 5 days, hopefully, because I would like to see the market bounce back up. I would like to see it provide people a higher price to exit out of stocks like Apple and others. So let's look at what some of these stocks are doing. This is Apple, and Apple is down below. It's even worse if I put the chart on from today, and we'll look at some action today in a few minutes. But Apple's below its 200-day moving average. Apple is rolling. Oh, it's rolled over already, and it's trying to catch a falling knife to buy this stock. In fact, the Apple situation is so bad that when they reported their earnings, they announced that they're no longer going to report the sales of the number of iPhone units that they're selling. And that's a sign that this is a industry that has reached a top, and that's affecting semiconductor stocks, Apple suppliers. This is a complete disaster. But the idea that Kramer said that, well, if reporters would just stop reporting the bad news, the stock could go up. That's not a way to invest in the stock market. It's just not. And Apple is going to go lower until there's a panic washout in the stock market. We'll talk about what it's going to take to for us to be able to identify panic washout. But until panic washout happens, any rallies of 2 or 3 days are exit opportunities. And there's no reason to think this correction is going to end this year. But here's NVIDIA. NVIDIA and Apple were among the most popularly owned stocks to hold. Look, remember the Robinhood account, the Robinhood people. Apple is the top owned stock, period. And NVIDIA is on this list below the top 20 or whatever I got right there. But Apple's the most widely owned stock. And this is why one of the reasons I'm emphasizing, get out of it. If you're watching this video, get out of Apple. Just get out. No one can know when the bottom is, and this thing could fall for a very long time. And the same is the case with NVIDIA. NVIDIA is in collapse. And Adobe, which reported positive earnings in October and gapped up, is now below its lows all year. In fact, the entire stock market is below the S&P and NASDAQ as of this moment are below their January the 1st lows. Almost everyone invested in the stock market is losing money this year. It's time for people can make money. People can make money, but they have to make changes. They have to, get out of bad stocks, and get into things that are bucking the trend. They have to lower the volatility in their account. That can mean raising some cash in times like this. At least raise some cash so you can buy when things wash out at lower levels, because this is going to go lower, even if we do get an update tomorrow or Friday or even a couple of days next week. I hope so. But over the next couple months, this is a bad market. And look at Facebook. Facebook, this is yesterday's action. It's even worse if I put on today. It's down, NVIDIA is down like 50% from the high. But look at Facebook. It's a disaster. And here's Boeing, which is actually down even more today, but it's rolling over. And Boeing's significant because it broke out in October, and it was a false breakout. It went nowhere, and now it's rolling over. But Boeing is in the Dow. Boeing had been a major leadership stock for the past 2 years. And around Labor Day, I was saying that, look, if the stock market, because we hadn't topped and rolled over yet, and I'm not looking to predict the future. I don't make investment decisions or trading decisions for that matter by trying to predict the future. And I don't hold on to Elliott wave theorists who do, or people on CNBC who just yell things out about, future predictions or everything's okay. I look at the trends of the market and I adapt when they change. And on Labor Day, we were not we had not topped yet. And I couldn't predict, hey, is it going to top at the end of the month? Is it going to top in December or in 2019? I don't predict. I adapt when things change. And around Labor Day, the market was still above its 200-day moving averages. I was asking the question, if the stock market rallies into the end of the year, what is going to drive the stock market higher? And I looked through the stocks in the market to figure out, by the way the charts looked with individual stocks, individual sectors, what could drive the market higher? Where would the leadership be? And I figured it was going to be in stocks like Boeing, the defensive, not defensive in the sense of Procter & Gamble defensive, but defense industry stocks, war industry stocks, because they were consolidating. They had the potential to break out. And if they could break out and rally to the end of the year, that would drive the market higher. That would drive the Dow higher. They broke out, and it was a fake breakout, and they came back down. And there's no leadership in this stock market at new highs to drive the overall market higher. It does not exist. The sectors holding up are things like or outperforming are utilities, drug stocks like McDonald's. These are stocks that are seen to be immune to recessions, stocks such as utilities, historically go up when the Fed lowers interest rates. And these are not these are stocks that do good, sectors that do good at the end of a bull market or the first part of a bear market. So the sector structure of what is leading the market is telling us this is a market that is, it's combine the sector structure with the price action of what the averages are doing. It's a bear market. When the stock market averages are trading below their 200-day moving averages for more than just a couple weeks, that's a warning that you're tipping into a bear market or already in one. But there's a major point I want to make. So here's Activision. Look what Activision's done. Activision was a leadership stock, down from $85 to a close of $49 yesterday, down even more today. And here's the VIX. So I'm going to get away from this PowerPoint presentation, and I want to show you. I'm going to return to the PowerPoint in a minute to close up, but there's a huge, huge, huge point I want to share with you about the market. Okay, and I'm going to use the live charts to do that. So, how are we in a bull market or are we in a bear market? So, to answer a question like that, you have to define what you're talking about, because people throw these words around. What does it mean to be in a bull market? What does it mean to be in a bear market? Well, I will define my definition. So a bull market, I call it a stage 2 market, is one in which the market is trading above the 200-day moving averages. And you can say a stock or sector is a stock in a bull market in itself. Or a sector, regardless, is trading above the 200-day moving average, and that moving average is acting as support. Yes, it can go below it briefly, but if it does, it'll bounce back up within, at the most, 3 weeks. And that's been the trend of the stock market since 2009, up until last month. A bear market is not, I don't define a bear market by one down 30% or one down by 20%, because once you get to that point, it's not a useful definition. If stock market crashes and goes down 40% or something, and then we say, well, it's a bear market, then you're just as likely to be selling on the bottom. In fact, that's what happened to people in 2009 or 2008. They go, oh, it's down 40% now, I'm selling. That type of definition is absolutely useless. You need a better definition, which is a simple one. When a market is trading below the 200-day moving average, and that moving average is now acting as resistance, you're in a bear market, and that can go on for years. So if we think about gold actually fell into a bear market like that in the fall of 2012 and dropped for 4 years. Mining stocks fell 90% during that time. And the 200-day moving average acted as resistance for those 4 years. There were a couple of times in which gold rallied back up to it, but it never got above it for more than like 2 or 3 weeks until 2016. So when you're in a market environment which 200-day moving average is acting as resistance, that leads to big losses for people who hold or try to keep buying the bottom. And if you're at the start of one, because it just started last month, you're looking ahead at devastating losses to come at this moment. Now, I know they're all saying on CNBC, don't worry, we're going to get an end of the year rally. But those same people were calling for a big rally after the election, and it didn't happen. And they're not looking at the trends of the market at all. Now, there's something interesting happening that has me convinced that it's a bear market, because I know it's tough to say it's a bear market when everyone else is pretty much complacent and no one on the television is saying it's a bear market. So to say it's a bear market means, oh, I'm going against all these people on television that are, paid hundreds of thousands of dollars and whatever. So let me show you what's going on. So now we're looking at today's action. And first thing I'm going to tell you is here's NVIDIA, and NVIDIA is doing something nice at the moment at 1026. NVIDIA gap down at least $11, and now it's down $3. So it's coming back, okay? Now, if NVIDIA were to finish in the green today, or actually just close here even, that's the type of price action that would actually suggest NVIDIA might bounce here, or at least hold up for a couple days. And if other stocks do that today, that also would tell me that even though the open's been brutal, even though yesterday's been terrible, and even though the past couple days have been pretty nasty, yeah, we can get a bounce for a couple days. And that's not based on a prediction on the end of the year rally or just crazy sayings. News doesn't matter, but it's based on trends and price action. But that is short-term price action. I mean, it's very short-term, and it would just suggest things can hold up for a couple of days, but then it would just be a temporary dead cat bounce, and we'd be going lower after it ends. But we'll have to watch. Can other stocks bounce like NVIDIA? Facebook trying to come off the low today. Microsoft, not the same case. What about Apple? Not really. But this is short-term price action I'm speaking of. And everybody focuses on short-term price action. What's the stock market doing today? If it goes green, everyone's going to get excited. Even though it's in a downtrend, even though Apple's below its 200-day moving average. The short-term price action isn't that important unless you're day trading. I'm not a day trader. Maybe you are, but most people aren't. And most people really aren't that good at it, honestly. But this isn't what I want to talk about. Let's just look at some of these stocks. I'm ranking the stocks in S&P 500 by volume. So here's a stock completely broken down. GE crashing, of course. Apple has collapsed. Now, look at the sharp drop that's taking place in Apple. And Microsoft has rolled over. NVIDIA, look at that sharp drop in the past 2 months. Facebook, an awful sharp drop. Bank of America has rolled over. Micron, sharp drop. Sharp drop. Target crashing today. Ford, sharp drop for the past couple months. Look at this stock. Awful gap down. Twitter rolled over. Intel isn't actually dropping as bad as the others, but Netflix, of course, is in collapse. L Brands crashed today. Cisco. Now I'm just ranking. Look at this. Here's a stock crashed yesterday, now down 3%. Verizon, finally a stock on a high, but Verizon is utility stock, so it's a defensive stock. Comcast, actually a bad, nasty day today. Pfizer's probably near high because it's a drug stock, and it's therefore a defensive stock. Fox doing good. Well, so one stock, finally, that's not just a pure defense. 1 out of 22 stocks trading by the most volume today. Fox, which is kind of near a high. Here it is. Here, I'm having trouble. There's Fox. So Wells Fargo, PayPal, gap down. Amazon crashing, basically. At least a sharp drop. An awful drop. An awful drop. So anyway, you get the picture. Here's another one crashed. I want to make a very simple point. individual stocks are just going like this. They're just whoop, and they're falling 20%. Stocks like Nvidia are down at least 40%. These are substantial drops in a very short period of time. And the VIX is still around 20. I'm not sure what it's at this very second, but it's not even at 25. There's no fear in the market at all. And the stocks are going down like this. Now, the market averages aren't as down as much as the stocks are down. Most people, a lot of people have the bulk of their money in ETFs and in mutual funds and so forth. And these are not falling like these individual stocks are falling at all, for the most part. SPY is only down a little bit year to date now, maybe 1% or 2%, the SPY ETF. But individual stocks are going down like this. The one reason why the ETFs aren't as down as much as these stocks is because they do have these defensive issues, which are, doing better. But they're just a fraction of the market, but they do help the ETFs. Stocks like Johnson & Johnson, stocks like Pfizer, stocks like McDonald's help the Dow when stocks like Apple are going like that. So individual investors who don't have their whole account in these tech stocks aren't suffering as much as the stocks are suffering. So they're not as concerned. They're not really, if you're not paying attention to what's happening and you just got your money in these ETFs or mutual funds, you're not really losing a whole lot of money, even though these stocks are going straight down or have been. It's like a falling knife. Now, what I want to tell you is that action in these stocks like this, when there's no fear in the market yet, is what has me convinced that this is now a real bear market. Now, I know no one likes to say that. The masses are fully invested and they want stock picks. They want to go long. But I am doing this for real. I show people my real account with that Robinhood, and I put out reports about, hey, there's a good position, I think, here to bet against 5 stocks. We got a good entry point in these 5 stocks. Next week it might be, hey, here's some mining stocks lined up. But I only do this when I think I got good entry points. And because I'm showing, I want to make money, and I'm showing people what I'm really doing in that Robinhood account. And I'm not trying to just promote people or sell them on the idea, hey, buy Bitcoin, put $100 in, you're going to make $1 million, because I'm not trying to do that, because it's crazy. And it's just as crazy to think, put in $100 in a couple of stocks or calls and you're going to make $1 million. This is about making real money. Now, in 2000, listen to this, this is really important. In 2007, in October, from August to December, is when that bear market started. The stock market tipped over into a bear market August 2007 through December. That was the topping process over a couple months. Now, every top is a little bit different than the last one, just as every bottom can be in certain ways. That top, I think, in hindsight, took longer than this one. This one just practically overnight. But one thing that happened from August to December 2007, the start of the bear market, first of all, the obvious, no one was really concerned until it crashed in 2008 on CNBC. Most of the talk was, oh, don't worry, buy these tech stocks, because they weren't falling as much as they are now. But something happened that caused me now to get very bearish on the stock market. First of all, going into 2007, I wasn't really bearish on the stock market because I wasn't really paying attention to it, frankly. because I was a gold trader back then. From 2002 to actually 2006, I mostly just traded gold. And I hardly paid any attention to the U.S. stock market at all. But then in 2007, that changed because I got out of the gold stuff at some point in 2006 and just stepped away and was just watching at that really for months. And in 2007, the market took a big hit in August, came back and made a minor new high in October. But something was happening that is now happening that no one is talking about in a meaningful way at all. In 2007, in October and November, as the final top was being put in, I used the charting program I just showed you, TC2000, the live charts I just showed you, looked at all the sectors, looked at all the stocks, and they're doing, in a certain sense, what is happening now. They were falling. Even though the market averages appeared okay, these stocks as a whole, most stocks in the stock market in 2007 in November were way below their 200-day moving averages. So far below those 200-day moving averages that they were to rally back up to them would really take a feat. So those moving averages were now solid resistance. Bank stocks had been in bear markets for over a year, and so were home building stocks. But almost all stocks were doing that. The stock market as a whole, the individual sectors, the individual stocks were way below their 200-day moving averages in November of 2007. Now, Facebook, Amazon, Google, Microsoft, some of these tech stocks were not. They were actually still acting strong, near their highs. In fact, they made new highs in October 2007. But the bulk of the stock market was in a bear market. It was awful. And that's what convinced me that that was a bear market. It took me some time to adjust to that, the market action and so forth, and position myself, get out of things, position myself to actually benefit from all that. So I did when it was all over. But I realized, this is really bad, because in November, October 2007, nobody cared what was going on, but most of the stocks were substantially below their 200-day moving averages, most of the sectors too. And I put out a report. I can't remember the exact date. It might have been the first week of December or the last, sometime in November or December. But I put out a PDF report saying we're now in a bear market because of that. Now, this is the thing. The same thing is happening now. Even though the S&P is still around 2,600, the stocks in the stock market, the majority of them are below their 200-day moving averages. The leaders are getting killed completely. The stocks like NVIDIA are collapsing. It's just going straight down. That's bear market action. These stocks have no sign of putting in a bottom. We looked at NVIDIA a few minutes ago. NVIDIA looks like it could hold up here for a couple days. Hopefully. Maybe it could go green today or tomorrow and hold up for a week. But that's not a bottom. It would just break down by the end of before the year's over and fall again. Until there's a panic washout in the stock market, all bounces must be treated as temporary bounces, just like the one at the beginning of this month should have been treated. That move in the market rallied into the election and topped out because there's been no end to this drop. Drops like this do not end until there's a panic washout. And the stocks are in bear markets. Individual stocks, there's more individual. The vast majority of the stock market is already in a clear bear market because a stock like NVIDIA is so far away from its 200-day moving average that it's going to take a long time for it to get above it. It could take years. Years. That's what we're facing, and that's what we need to adapt to. All I care about is helping you make money. I can't really Look, my membership group renews. You can get into it for $7.97, but it renews every 30 days. What is it? This actually does something very important. A lot of trading services out there cost like $2,000, and they charge you, okay, 12 months, give us $2,000 up front. So you're taking the big risk, a big risk, a giant leap of faith that I'm going to give someone $2,000. They're going to help me make money over 12 months. If they don't, they keep the two grand, and you're high and dry. With my service, because it renews every single month, if it's not for you, then you're out. You don't have to put up $2,000 and risk all that kind of money. You get in, and if this isn't going to really help you and you make that decision, you don't lose anything. You just tried it, boom, you're out. And so that incentivizes me to do the best I can do. And that's why this is real. This isn't about promises like people are making on Bitcoin, put in $100 and make $1 million. This is real. And I can't, sometimes there's markets in which quick money can be made, but really, I don't think anyone should be trying to make quick money in a market like this with their entire account. I'm shorting stocks. I'm betting against stocks. Some of the 5 stocks I talked about betting against last Monday that are just collapsing. That creates great gains on those trades, but I'm not putting my whole account in that because this isn't a market for big risks. But if you can make small gains, with a portion of your money while everyone else is losing, and then you're ready when things turn around, that's great. Or when things finally turn around for good with the gold and mining stocks and have some money in that, that's great too, because I think they're going to go up for years, but we're not at that final shift point yet. Now, we go back to the PowerPoint and make a couple more final observations. So this is the VIX, and that's yesterday's close. And at the moment, it's at around $23. I've just checked the live quote. It's around $23. This is not even above where it was in October. And the VIX measures fear in the stock market. It's measuring the premium that people are paying in the options market for volatility on the options they buy. To make a long story short, when the people panic in the options market, they scramble to buy puts and the VIX goes up. Critical market bottoms typically come when the VIX is at least above 30, and we haven't gotten above 30 on this entire drop. And until we do that, it's probably going to go above 40 before this really ends. We can't call an end to the drop. And it's probably not going to end this year. Yeah, we can get a bounce for a week at some point, maybe hold up for 2 weeks. But this has all the indications to me that this drop is not going to end until sometime next year. And I have no way to predict when. It can end in January, it can end in May, it can end in June. I don't know. I can't predict the future. I don't try to predict the future. I try to align my money with what the trend of the markets are doing and accept when they change and adapt to that. And that's why that Robinhood account is up since I opened it up around Labor Day and not down when the market is certainly down from the day I opened it. And a funny thing about that Robinhood account, I'm not trying to make a killing in it because 2 out of 7 positions at the moment are in cash because I took a defensive stance when this started to happen in October. 2 out of 7 positions are in cash. I might change that before the year's over, but that's where we are. So again, returning back to November 2007, individual stocks were deep in bear markets in October, November 2007, and they are right now. Despite that, people had no care in the world. you could say perhaps there's some anxiety among investors. By January 2008, that was certainly the case. And the market actually put in a temporary bottom, bounced in around March, and then rolled over again. But those stocks began bear markets in November 2007. Bear markets don't end until you go through this psychological cycle of fear, desperation, panic, capitulation. No one's capitulating on tech stocks yet. I just heard yesterday Jim Cramer say if reporters weren't putting out bad news, Apple should go up. And he just said something this morning similar, like when I had CNBC on. This is a long cycle that takes a lot of time. It took a year from November 2007 to March 2009. With the gold stocks and gold itself, it took 4 years for this cycle to play out. We're just at the beginning of it. And that creates it, for those people on that Robinhood account that I showed you, this is what they're owning. People who've got their account thrown in these stocks are going to lose a lot of money as this cycle plays out. But it doesn't have to be that way. They can make money betting against stocks. They can make money shifting money into defensive issues or things that are going to actually break away from the overall stock market, such as gold and mining stocks, once the Fed ends up reacting to all this and stops raising rates and things just more shifts take place in the global financial system. There's going to be huge ways to profit over the next couple of years. But sitting in these stocks and doing nothing is what most people in the United States are going to do. And they're going to go through this psychological cycle. My hope is someone listening will make changes so they won't have to go through that. But, it's just what it is. Now, here's gold. I mentioned gold several times. Gold had a pullback from 1370 down into August. But since October, gold's actually up. It's outperforming the stock market. As you can see from the bottom, gold divided by S&P relative strength ratio. And gold's really a topic for a whole nother video, but I think once gold clears 1240, and it can do that before this year's over, it's going to go crazy. And it's already outperforming the market. No one cares about it, but once it starts to go up enough, people will care about it and want to get interested in it and involved in it. So this is an opportunity, once it breaks out, to go up, possibly for years. There's ways to make money in these markets. The biggest mistake that people make, and I speak from experience, that's a whole nother video. We're talking for a long time already, but it's betting on one thing with all your money. That's the biggest mistake people make. And that's not just people who don't know anything. It's the professionals. That's what they mostly do too. One thing, one trend, all their money betting on it. And that causes people to eventually sell out when things go down and they can't take a bear market or a correction because they've got all their money in one thing. And sometimes they then give up and get out of the investing and trading game forever, or get shaken out on the bottom because all their money is betting on one thing. There are a lot of people who sold out in 2008, 2009, never got back in the stock market. The reason why is because they had all their money in it and couldn't take it. And the same thing is going to happen again to many people. What I'm trying to do is go short in junk stocks as a way to make some money and go long in things performing better than the US stock market are doing. But it's completely over for big cap fad tech. NVIDIA is going to make people lose lots of money in the next couple of years. So is Apple. So is Facebook. So is Adobe. So is even Amazon. So it's Amazon that I heard Kramer say it makes no sense basically for the stock to be down. Nothing is wrong with the company is what he said. We're not investing in the notion that there's good things or bad things happening with companies. We're investing in market trends. And the reality is these stocks went up for years. They're bubbles. And now they're in downtrends. Doesn't matter if Amazon's a good company or bad company. If I've got a, it doesn't matter anymore. It doesn't matter if the news is good or bad. It's over for big cap fed tech. It's over. Completely over. It's over for these stocks. So finally, just to end the video, grab my Cyber Monday offer, be a part of these markets with me, get more involved, get access to my 7-position Robinhood portfolio, be notified when I make a new trade in it or sell something in it. You'll know instantly what I'm doing. Hopefully, if I can continue to make money, it'll help you make money. I can't make promises. That's like the typical investment disclaimer legally have to make. I can't promise you I'm going to make money. I will promise you I'm doing this for real. I'm not getting on TV throwing slogans at you to try to make you feel better or something. This is real. If I lose money, you're going to see me lose money. Do we see what the guys on Fast Money are doing? I don't. But you also will get access to my special reports, such as the one I did Monday, 5 stocks to bet against, and they're just dumping. Yesterday, total disaster for them alone. But you're also going to get special reports about the good longs I take. And I issue these reports when there's good entry points and setups. And you get even more information than this, do frequent updates and so forth. But let's hope we get an update before the close. I would like to see people get an opportunity to get out in NVIDIA at a little bit of a higher price than it is, get out of Apple a little bit higher price than it is, and breathe a little bit easier. Actually, Facebook's in the green at the moment. That's nice for people in Facebook if they'll just take advantage of that and get out. I hope they do. We're in a bear market now. I'm convinced of it with those stocks trading. So many of them way below their 200-day moving averages. That's what happened in October, November 2007. It's what's happening again. So thanks for joining me for this update. On my website where this video is, I've got an update. I got the link for you to take advantage of the trial offer. It ends on Monday. And have a good Thanksgiving dinner with your family. I will. And if you're traveling, have safe travels too.